Hey everyone, on this special edition of the Final Bar, I will be sharing with you the top 5 charts of 2022. We'll talk about lessons learned in a tumultuous year for investing and some of the themes, charts, and approaches that should prove very valuable as we try to navigate 2023. Ladies and gentlemen, this is the Final Bar. Hello, everyone, and welcome to the special edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist at StockCharts.com in a snowy Redmond, Washington. Here as we navigate year-end 2022, looking to the new year of 2023, it's all about a time to look back and reflect on lessons learned. 2022 was a challenging year. The good news, hopefully what you have found, even if your investment returns may have been challenged, I have found in my career that I've learned way more during bear market phases than bull market phases. So 2022 was an educational year in many ways, right? You learned about a lot of different dynamics and the interplay of different forces causing asset prices to move. But to be honest with you, as we think about 2023, I think it's important to look back and look at some of the key charts that tell the story really of what 2022 really involved, and think about some of the most important themes that may come out in the year to come. We're going to start with chart number 1 of my top 5 charts of 2022, which is the S&P 500 index last couple of years using Fibonacci retracements. Now, when we look at this chart, it really tells the story of the market rotating from the bullish phase out of the March 2020 market low, sort of the COVID low, this acceleration to the upside and move to new all-time highs yet again in the third quarter of 2020, powering higher in November of that year. 2021, an incredibly strong year, right? Higher highs, higher lows. At most, we had a 5% pullback, if that, but I mean, really, really minimal pullbacks. And then you compare that to 2022, where it was all about the drawdown. Now, Fibonacci retracements are really designed for this sort of setup, right? This sort of environment where you have a big move, whether it's a big move higher or a big move lower, and then you're sort of retracing or you're moving within those extremes. That's what Fibonacci retracements are designed to capture. Once you define sort of a framework for the market, let's identify some key levels or anticipate some potential levels of support and resistance. So what I did in 2022, when I think about this chart, at the beginning of the year, I actually used a shorter term objective, because taking the March 2020 low to the January 2022 high, the first support level is around 3,800, really 3,815. The problem is when you're up at 4,800, 3,800 seems like a ridiculous downside target. It just doesn't seem very reachable, even though, of course, it finally was, but that was months later, right? When you're trying to think about short-term support, you need to use shorter-term levels. So the time frame you use for the Fibonacci retracements often will dictate the importance or the long-term or short-term nature of the objectives that you come up with. So what I did was I picked, instead of the March 2020 low, I went with a secondary low that I thought was still very meaningful, which was the September 2020 low. So if you remember 2020, right, we bottomed out in March. We had a V bottom, accelerated out of the lows. The first real pullback was in June, sort of this pennant pattern of higher highs and higher lows and lower highs. We resolved to the upside. But then the September, October, November period was the longest consolidation really during the entire bull market phase from 2020 to 2022. It took us about 3 months after making that new high in September to finally get above it in late November. So this was a consolidation pattern, a coil pattern of lower highs and higher lows, call it a symmetrical triangle pattern. And when that was resolved to the upside in November, that was one of the great signals of 2020, validating the fact that a bull market phase was really engaged with high likelihood of higher highs, which played out beautifully in 2021. So that low of that pattern in September sounded like a really good starting point. That's just about 3,200. Then we take the January 2022 high around 4,800. These green horizontal lines show you the key Fibonacci levels. The first one, 38.2%, is 4,200. The 50% level is just above 4,000, and the 61.8% just above 3,800. So 4,200 was our first downside objective. You can see that's basically where we bounced off in January. We retested that in February and March, and every time we tried to break below, it was repelled, right? We bounced higher. Then we finally broke below that in April, which was a sign that there was much further downside most likely to be had. But you'll even notice later, after we rallied in the into the August peak, we got just above that 38.2% retracement level before failing and coming back. So that ended up, that 4,200 level ended up being an important level to watch through the course of 2022. We had the 4,000 level before that as a secondary level, but the real one was the 61.8% level, which is here around 38.20. That ended up being the low in May. That ended up being, really we gapped below there in June, but didn't really sustain a move below those levels. We bounced off of there once again. After we broke below it in September, you can see that that served as overhead resistance in October and November. Now that we have sold off here in mid to late December, we're right back to, that's right, the 3,800 level, which is again a 61.8% retracement of that time frame. Now let's bring in the longer time frame, which are the pink horizontal lines, which takes March 2020 to January 2022. 38.2% of the way is just above 3,800 at 3,815. That's why this pink shaded area is so important, because it's a confluence of support from two different time frames, right? Using the shorter term time frame I mentioned and the much longer term time frame, both of those come up with around 3,800 to 3,820 as a key level of support. That's why I've shaded that area in pink, and that has ended up being a really important pivot point for the markets in 2022. The next level down would be 50%, which is 3,500. That was the low for the year in October. We broke it on an intraday basis there in mid-October, and we rallied off of there. This is why my eventual downside target for the S&P at the beginning of next year is 3,200, because that would be a 61.8% retracement of this entire distance. It would also be a 100% retracement back to the September 2020 lows. So a move down to 3,200 would make a ton of sense from this long-term Fibonacci retracement framework. So the first chart of 5 in 2022 is the S&P 500 using Fibonacci retracements. I think it sets the stage, really sets a framework for how to understand how a down year like 2022 can stay plugged into some of the key levels that you could have identified by looking at the trajectory and the pace of the uptrend, really the movement, the trajectory of the S&P off of the lows in March 2020 to their highs in 2022. Our second of our top 5 charts of 2022 is interest rates, right? And here we're looking at the 10-year Treasury yield, $TNX. We're also looking at a couple other series here just to orient you to the chart. We have the daily a reading of the 10-year Treasury yield. We have the 50-day and 200-day moving averages up there at the top. Here we have a ratio of value versus growth, and that's using the Russell 1000 value ETF, the Russell 1000 growth ETF. So if this line is going up, value is outperforming. If the line's going down, growth is outperforming. Finally, at the bottom, we're looking at the shape of the yield curve, 10-year yields minus 2-year yields. This is a common way of looking at the slope or the shape of the yield curve. Is the yield curve steepening or flattening? Is the yield curve inverted? This is what that simple spread can allow you to evaluate. So let's talk about what this chart told us in 2022. We have to start in 2021, right? If you think about it, 2021 was when we came off of, we were down at like half a percent on the 10-year, right? Going around the COVID lows up to, around 150. And most of 2021 was fluctuating around that 150 level, which is sort of right about here. So if you look, the median, sort of the midpoint of the 10-year in 2021 is around 1.5%. Look at how that consolidation, sort of that sideways, trend in bonds, resolved to be a clear downtrend in bonds or a clear rally in rates. Look at how rates accelerated to the upside. Back here, we're talking about, is 2% a possible target? What about 2.25, 250 even? You can see, of course, we got all the way up to 425. So charting this rally in rates, so this rise in rates as the Fed was, really starting to tighten their conditions, really change their policy practice from 2021 to 2022, you can see how rates really accelerated to the upside. I've highlighted 2 levels here. The 2018 high, which is around 325, that's this pink horizontal line. It lines up with a high that's off the viewable side there on the left. And then I highlighted the June 2022 high, which is around 350. That's right, right around there. So we can see how we, got to the 2018 high in June. That was a significant level that it seemed, unreachable when we were back at 0.5%. We pulled back to around 260 and then accelerated to a new high there. It got all the way up to 425 in the fourth quarter. From there, we actually came down, and as rates came off in the fourth quarter, you can see we pulled right back to that 2022 high. So a lot of times what I talk about is using the final bar and looking to the left to identify key levels of support and resistance. This is why we had that 2022 high as a horizontal line just below 350. This is why pulling back from 425 to 350 seemed like a very reasonable retracement after that rally, or after that rise in rates. Now, the second chart down is why this chart is one of the top 5 of 2022, because it told us all we needed to know in a lot of ways about leadership themes from equities, right? When rates are going higher, that tends to be better for value stocks. When rates are coming down, that tends to be better for growth stocks. You can see in the first half of the year, rates going higher, growth stocks struggling, value stocks working, and that's what's working better. In the middle of the year, going into the summer, you saw rates come off. It tested that 2018 high, and you saw growth stocks actually did pretty well. Then once again, starting at the August market peak, we saw bonds sell off along with stocks. We saw rates go up to make their 2022 high around 4.25. You can see how value stocks emerged really, really well. Fourth quarter has been a little unusual because rates came off, and value and growth were actually in lockstep. They're actually moving pretty well together here. Just in the last week, as we're going here, recording this in late December, you can see how rates are popping to the upside, and you can see how the value is starting to outperform growth once again. Now, why does that work? It really goes back to the basics of what value stocks and growth stocks actually do. And the way I like to explain it is the reason why growth stocks struggle when rates are rising is because growth stocks are all about projecting future earnings growth, right? What is it worth to own this company that has these future earnings projections going forward years down the road? And the thing is, when rates get higher, those future earnings are just less attractive, right? They're less valuable because you can get more for your money now with higher interest rates. And so higher rates tend to be worse for growth, higher rates tend to be better for value, and vice versa. So as we're going into next year, it's all about, I think, what happens with rates, right? If the Fed continues to, have a hawkish tone, which they appear to be doing, they continue to raise rates, albeit at a slower pace. Most likely that means rates go higher from here, even at the longer end, the 10-year, the 30-year. And what that most likely means is it's going to be difficult for growth stocks to do well. What's interesting is certain areas of the equity market have had a pretty decent 2022. Energy, probably one of the best examples, a pretty good year for energy stocks. Material stocks did pretty well as well. Not necessarily a blowout positive year, but not too painful of a year, right? They pull back just a little bit. So looking at rates and looking at leadership is going to be an important theme, I think, going forward, particularly as we navigate the end of this Fed tightening cycle and see what the world looks like going forward. Our benchmarks are very growth oriented. So if you expect, or if you want the S&P and the NASDAQ to do well, it most likely has to be in an environment where rates are going lower or remaining lower, because rising rates are tough for growth. This is the shape of the yield curve. You can see the yield curve has been steadily flattening over the last 18 months. And you can see when it gets below the 0 level, first tested it in April, then getting below there for good here in July. Inverted yield curve tends to be a good predictor of recession. It suggests that we are basically at or near recessionary conditions going into next year. Not encouraging, and certainly not in general bullish sign for stocks. Our third chart of our top 3 is the US dollar, also looking at other asset classes like commodities. With the US dollar, I've called in 2022 the wrecking ball for risk assets. And if you look at what happened from January of 2022 to September of 2022, this consistent rise in the dollar meant a couple things. Number one, very difficult for risk assets to materialize any sort of gains. You had a situation where crude oil prices rallied, where gold prices at times rallied, but the rising dollar, which is the denominator for both of these, right? Crude oil and gold are denominated in dollars. So when the dollar is strengthening so much, think of it that way, that you basically have the denominator growing a great deal. So it's tough for commodities to look attractive given the rising dollar. That also has implications for U.S. versus non-U.S. stocks. And that's why the second panel down in purple is a ratio of the S&P versus ACWI ex-U.S. So the S&P 500, obviously a U.S. benchmark, All Country World Index is a commonly used global equity index. And this one in particular is an ETF looking at ACWI ex-US. So basically taking the non-US part of this global index. So this ratio is basically US versus everything else versus non-US stocks. So if this line is going up, US stocks are outperforming non-US. If this line is going down, US stocks are underperforming non-US stocks. So as a US-based investor, the reason why this chart is so meaningful, a couple things. Number one, as a US-based investor, it has not behooved us as US-based investors to go outside the US with our capital. Even charts like India, which earlier in 2022 looked absolutely fantastic, testing new all-time highs for the Sensex and the Nifty. The challenge is because of the strong dollar, your gains that you would get from the equities outside the U.S., you lose that when you convert the currency differential, right? Because so you would have lost all your equity gains when you convert your gains back to dollars. That's why it's been not a great environment to look outside the U.S. But look at what's happened in the last couple of months. In the fourth quarter, we've seen a big change, rotation from stronger dollar to weaker dollar, rotation from U.S. outperforming everything else to U.S. underperforming non-U.S. stocks. This is where, not just India anymore, but it's other Asia like Japan, developed Europe like Germany, Spain, Italy, France, all of those benchmarks, in ETF, U.S. listed ETFs, all of a sudden rotating to the upside because the weaker dollar makes them a much better, much more attractive proposition. This dollar chart was a key chart to focus on in 2022, and that persistently strong dollar through most of this year told you a lot about the conditions that remained risk off. I would be watching this chart closely going into the beginning of next year for a number of reasons. Inflation can be manifested in a number of places. It can certainly be manifested in oil prices and in energy prices. So watching the chart of crude oil, energy stocks have been struggling as of late. Crude oil prices have been coming down. Do you see any sort of movement to the upside for crude oil? We had this situation for most of the year where crude oil and gold were moving together. That changed in the fourth quarter where oil prices came off and gold actually rallied. I think gold stocks going into the new year, when you think about gold's traditional role as a safe haven, when you think about how gold has been, undervalued or has been underappreciated by investors, certainly not been able to materialize any meaningful gains since the first quarter of 2022. I think we could be setting up for another move higher for commodities, but particularly for precious metals like gold and silver. So this chart really combines a lot of those key themes that evolved through the course of 2022. I will be watching this chart closely. It's part of my Mindful Investor Live chart list because I think there'll be important themes to watch in 2023 as well. Our fourth chart of our top 5 in 2022 is a simple one. It's the only individual stock we're going to feature in our top 5 this year, and it's Alphabet, ticker GOOG. I get a lot of questions on the ticker for Alphabet. I honestly think you can use them interchangeably. We're using the Class C shares here, which are non-voting shares. GOOGL is the main, the Class A shares for Alphabet. To be honest with you, the correlations are very high. There's a minimal difference, a bit of a premium at times between the two, but honestly negligible, I think, relative to the value of analyzing the trend. So I tend to use those tickers interchangeably. Both of those tickers are technically included in the S&P 500 as individual listings, by the way. The reason why I wanted to feature Alphabet as one of my top 5 charts, because I think it illustrates so beautifully the rotation in growth stocks from a bullish phase in 2021 to a bearish phase in 2022. Go back with me to the third quarter of 2022 and look at how bullish this chart had been through most of the year. Higher highs, higher lows in price, above 2 upward sloping moving averages. The RSI is in a bullish range, meaning the entire range moves higher. So when we rally, we tend to become overbought. When we have pullbacks, we rarely get below the 50-day, and the RSI tends to remain above 40. And that means the entire RSI has bumped up to a more bullish phase. The relative strength is strong because in 2021, the FANG stocks, particularly Alphabet and others like it, were just really dramatically outperforming the rest of the market. We started to change here in the third into the fourth quarter, and one of the most obvious examples of that was this bearish momentum divergence. Higher highs in price September to November, lower peaks in momentum September to November. You saw a similar thing with the S&P 500, which made higher highs in November into January with lower peaks in momentum. Alphabet was actually an early warning sign of sorts, suggesting that FANG trade, that growth trade, which had dominated for so long, was really starting to lighten up a little bit. Now look at how the chart evolved from the left half to the right half. We went from higher highs to lower highs, higher lows to lower lows, to upward sloping moving averages, to two downward sloping moving averages, the price above both moving averages to the price below both moving averages. We went from breaking resistance consistently to breaking support consistently. The RSI went from the bullish range down to the bearish range, where it rarely gets above 60 and often becomes oversold. The relative strength went from an uptrend to a downtrend. So somewhere along this way, Alphabet gave us a very clear picture, a very clear signal, an indication that the market was changing. There was a change of character from a bullish phase for growth stocks like Alphabet to a bearish phase. And the reason why this is one of the top 5 charts is I would encourage you to dig into this chart in a lot of detail. What did your toolkit tell you about this rotation? Where did you recognize that Alphabet had changed from bullish to bearish, right? What signals were you not paying attention to that, if you had, may have given you a better sense of what was happening to these growth leadership stocks that changed so dramatically in the first quarter? Thinking about these examples, clear examples of a rotation, and thinking about what your toolkit can do to help you anticipate this is just going to help you prepare much, much more effectively for the next bull market trend and the end of that bull market phase. If there's one thing I can tell you, there will be other bull markets and they will end. And looking at how this most recent one exhausted at the end of 21, beginning of 22 can be very, very instructive. Brings us to our final chart of top 5 of 2022, which is what I simply called the chart. I got into this practice years ago because people would ask me what the chart says about blah, about gold or about stocks or whatever. What do the charts say about stocks? And so I jokingly, tongue-in-cheek, created this chart, which I simply called the chart. And I would just say, yep, here's the chart. And I found it was really helpful because I took 4 or 5 indicators that I thought were the most important things to follow, and I just put them on one chart. Now, while I look at hundreds, if not thousands of charts on an average day, this allowed me to have one chart to follow as just a way to summarize the overall conditions as I saw them. Here are the 5 things on my chart, and I just created a new version of this in a couple of weeks ago in preparation for my year-end coverage of the market. So this is a new version. I have featured a version of the chart previously, but this is the new version. And in my Mindful Investor Live chart list, it will reflect now this new version of what I call the chart. From top to bottom, very quickly, this is the S&P 500 on a closing basis. We have the advanced decline line for the New York Stock Exchange. We have the percent of stocks in the S&P above their 50-day moving average, the bullish percent index for the S&P, and the consumer discretionary versus consumer staples ratio, what I call offense versus defense, using equal weighted ETFs. Let's go through each one of these very quickly, and I'll explain what they mean and why I think they're important. 2022 was all about the market in a downtrend. And what's beautiful about this year is if you take a trend line connecting the January high to the March high, you'll find that lines up very well with the August high and beautifully with the high in late November, early December. That trend line is currently just above 4,000. The benefit of using a trend line like this may not be the most effective trading system ever. However, what I have found with trend lines like this, particularly very clear trend lines, I'm not the only one watching this trend line. I know a lot of investors are, particularly longer-term investors, which means this is a great visual representation of that trend. As long as we remain below that trend line, the downtrend is in place by definition, because we would have to be making lower highs for that trend line to persist. If and when we break through that trend line, that will be meaningful. Number one, because it tells you that no longer is a representation of the trend, something's different. But also, I know so many people are going to be watching this trend line because it's so clear on the chart of the S&P, which means if and when we break it, there will be a lot of buyers that are very motivated at that moment because they will take that as a sign that the trend has changed. That's where a self-fulfilling prophecy will probably manifest itself with further upside. Chart 2, or the second panel, is the advanced decline line on the New York Stock Exchange, looking only at common stocks. This has also been in a downtrend, made a new low in October, just like the S&P did. As we've rallied here in October and November, I've been looking to see when this will make a new high. We made a new high in August, but it fizzled out. And from there, we really have now made a lower high in December. As long as we keep making lower highs and lower lows in the advanced decline line, it tells me regardless of what the major benchmark is doing, the trend in stocks that comprise those indexes is still down. Here's the percent of stocks above their 50-day moving average. Look at how we went down to single digits in June and in September. We went above 90% in August and December, and that really picks out the 4 most recent key turning points in the S&P. Now, you can see that this expanded because at the end of 21, beginning of 22, the entire range was compressed. We fluctuated between around 25 to 75%. that range broadened out as the volatility has increased in the second half of 2022. I would be watching this. You can see the horizontal line I have is at 50%. My general sense is if we remain above 50%, the conditions are overall constructive. If we remain below 50%, the conditions are negative. This is because if over half of the S&P members are above their 50-day, I take that as a positive. If more than 50% are below their 50-day, I take that as a bearish sentiment. It's all about participation, how many stocks are in uptrends. Right now, we are testing the 50% level. I'll be watching going into the new year if and when it breaks below 50%. And if so, when can it recover that level? The percent or the bullish percent index is a breadth indicator driven off of point and figure charts. This looks at 500 point and figure charts for the S&P 500 members and says, are they bullish or bearish? What's the most recent signal? As of late December here, 43% are bullish, which means over half are now bearish. Now that's down from around almost 80% at the end of November, which are bullish. Bullish percent index getting above 70% has often been a meaningful signal. More importantly, when it gets back below 70%, like it did here in January, like it did in April, like it did in mid-August, and like it did here in early December. Those are the 4 times in 2022 we went above 70% and broke below it. So that is one of my favorite sell signals to watch for. When we do get in a rally phase, see if it gets below there, because in extended bull market phases, we actually get above 70% and remain there. Look to see if that can happen in 2023, and that will tell me it's more of a sustained bull market phase, most likely. Finally, what I call offense over defense. When this line is going up, offense is outperforming. When it goes down, defense is outperforming. And this is basically looking at consumer discretionary versus consumer staples. What I like to say, things you want versus things you need. When conditions are good, consumers tend to be able to spend money on things you want. Things like travel and tourism and retail goods and luxury goods. When things are rough, you still have to buy toilet paper and probably tobacco and cigarettes and things like that, tobacco and alcohol. And so when the line is going down, that means people are probably opting away from discretionary purchases, but they're still, buying those staples that they're going to need, household goods that they're going to need in any case. So when the line's going down, that's things you need over things you want, and it's more defensive positioning. What's interesting about this ratio is overall, it's been flat for the last 6 months of the year. It really went down from November through July, but from there, it's been sideways. It's been decidedly neutral, meaning on an equal weighted basis, consumer discretionary and consumer staples fairly even. Going into next year, the reason why I think this is going to be helpful is to see if we get a breakdown. We talk about downside objectives for the S&P like 3,200, maybe even lower. I would think that would need to see this ratio go to a new low and break below the low we saw in July. That would, for me, indicate that investors are getting super defensive. They're going very much risk off, and that would most likely set up the stage for further deterioration in the markets. Folks, those are my top 5 charts of 2022. I want to thank you so much for a fantastic year for the Final Bar. It's been such a pleasure to bring the show with you. We've had a lot of fun and challenges, of course, but overall have really enjoyed putting the show together for you every week and every day, every trading day as we navigate 2022. We have a lot of really exciting plans for the Final Bar in 2023 as we get started here, including using our new studio in Redmond, Washington, bringing in more guests, bringing in a lot of really cool segments to focus on the markets, bringing in more live market updates as we build out the show to more than just 30 minutes, but a longer, bigger chunk of time here around the close. So a lot of excitement to come. But again, thanks so much for a great 2022. All the best and best wishes, and wish you well on your journey in 2023. I'm Dave Keller here at StockCharts.com. Be well, be safe. We'll see you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.